Thanks, everyone. As was mentioned, I'm a director of strategy at Consensys, and I'm also one of the founders and CEOs of Meridio, which is a company focused on creating fractional ownership of real estate on blockchain. Consensys, for those of you who may not know, is one of the world's largest blockchain companies that's building applications on Ethereum blockchain. We do everything from building applications to advising governments and Fortune 500 companies on what their blockchain strategy should be, and then build applications to solve for that. Today, I'm going to talk a little bit about what is blockchain, the last 10 years, and what that means kind of to where we are today. So we're going to talk about what we've seen take place in the first, I guess, 3 months of 3 quarters of this year, and then we're going to talk about what we are projected to see in kind of 2019. So we're going to go into the both past, present, and future. I guess to kick things off, 2008 was Satoshi's white paper that was released, and that was when the world first learned about what blockchain was. And in fact, it was a Bitcoin. Bitcoin was the first blockchain, and Bitcoin, the cryptocurrency, was the currency that sat on that blockchain. For folks that may not know, that ended up leading into some interesting experiments. People started trading that currency back and forth. People were experimenting with what that could actually mean. But in short, blockchain was now kind of released to the world, and people realized it's a better form of creating that digital scarcity. So for example, if I have a PDF and I send it to someone sitting in this room, we both have a copy of that PDF, and that's obviously not great if it's a currency, right? So creating that digital scarcity was important. People realized you can do interesting things with this currency. Someone even bought pizza, or 2 pies of pizza, for 10,000 Bitcoin. Today, that's roughly $64 million worth of 2 pies. Not the best investment decision, but that's kind of the first few years. Fast forward, people realized this technology can be used for really interesting things. And one of them was alternative coins, or altcoins. And what makes that kind of interesting is, can you take, basically, let's call it a train ticket, and make it a digital share, sell that train ticket to someone before the train is being built, and allow them to then, once the train is being built, of course, ride the train with that ticket. Now, the problem with that was, as that project or the tracks for that train are being laid, people started trading that train ticket back and forth as an investment instrument rather than using it to ride the train. And that's where altcoins started really getting a lot of sort of attention, and also led to exchanges starting to be formed. The most famous one was the Mt. Gox, and then the collapse of that. But around this time frame is where you really started to see adoption, where there was a kind of a run-up in Bitcoin prices. All the while, folks kind of got into a group of folks got into a room and realized we can make Bitcoin, the blockchain, far more advanced by adding on interesting layers and complex computer systems into it, and that led to the Ethereum blockchain. And what that basically did was create smart contracts. Smart contracts basically take something like Bitcoin, which is a cryptocurrency, but put business logic and legal logic on top of that. So for example, if I met up with someone that I may not know at this particular location for, let's say, 30 minutes, our GPS coordinates align in our phones, money goes automatically from my account to your account, and no longer need to have that trust component. So you can, of course, take that and enhance it even more by building much more complex business and legal logic onto that. But what that really did was really create really interesting use cases for what this business logic can mean, and ultimately led to a run-up in sort of prices for Ether and other cryptocurrencies as well. And all the while, you started seeing IBM, Microsoft, and a few of these other tech companies starting to pay attention, and that led to some more interesting findings. Altcoins became more robust. In 2017, you saw the ICO hype, where a lot of these coins came to market, over kind of 900 projects. You also are starting to see security-backed tokens or asset-backed tokens. These are pretty much securities instruments in pretty much confinement and oversight of the SEC. But these are kind of new instances of security tokens. And then you're all the while, this technology needs to scale to support this throughput. And what you're seeing there is scaling solutions for the protocol layer. So we're going to now shift over into what we saw this year in 2018. This is kind of this little bubble. So if we zoom in on that, we're seeing a pretty big drop off in prices. But while Bitcoin, Ether, and all these altcoins are seeing downward pressure, we're seeing interesting behavior in the projects that are taking place. So although retail kind of fueled a lot of the retail investors fueled a lot of the momentum coming in, you also saw institutional delusionment sort of take place early this year. But all the while giving confidence to people that are actually building real-world applications on blockchain. And that led to Andreessen Horowitz announcing earlier this year a $300 million fund. So that is on the way down of prices. You're seeing smart money starting to come in and actually support these projects that are building on blockchain technology. You also saw some financial instruments starting to become created. Things like the Bitcoin ETF was a big topic earlier this year. And that led to a little run up in Bitcoin, as you can see, while other altcoins continue to feel that downward pressure and face that. And of course, as that smart money comes in, and as you get to this point right here where we are today, the smartest so-called money starts to flow in, and endowments, sovereign wealth funds, large institutional asset managers now are coming in and starting to really participate and inject capital into the space. And that's really exciting because although people like to pay attention to the prices, for someone who's developing applications, we like to see where this capital is coming from. Is it the average individual who believes in speculation, or is it actual smart money that's really going to fuel growth and build robust applications on a blockchain? So quick recap, 80% price correction this year. Bitcoin volatility at all-time lows. It's trading at its tightest window today, so that's an interesting data point. I guess if you're looking for where momentum will sort of trend on a bull or bear market. Bitcoin has underperformed alternative coins, so those ICOs that you saw in bull markets. However, in bear market, it tends to outperform in those altcoins. And then finally, out of the major the primary 300 projects or so, only 1/3 of those projects have performed from a price perspective better than Bitcoin or Ether. So that's an interesting sort of point to take away as you think about where you see success in those projects. But ICO funding and funding in blockchain remains quite healthy. In fact, in 2017 and 2018, $12.3 billion were raised via ICOs. Average raises were around $29 million, and median capital was around $12 million, excuse me. However, there's a concentration of where this capital is being deployed. So the top 10 projects took over 50%, close to 50% of that capital home. So that means there's really a small group of projects, whether they're protocol layer, so the Bitcoin or Ether layer, along with applications that are building. So these are, feel free to take a picture of these slides. This is kind of the detail here from a capital injection perspective. And just to add a little bit more color, if you look at where that money comes from, the dark black, I guess the dark gray here, is in 2017 money that came into the asset class through ICOs or token launches. Over 2018, you're looking at 3.9 in 2017 versus 12.3. That's a pretty significant raise. But what I really want to call out here is kind of the blue bar. So $1 billion of capital injected into blockchain-based projects in 2017. In 2018, despite the downturn, $5.5 billion was injected. And that's 4x growth year over year. And that's all capital that's going into really mature mature projects with, backed by a pretty significant team. So, if you're going through a token launch where kind of anyone can invest versus someone like Andreessen or institutional, private equity fund or a VC fund investing, that gives a lot of growth. That 4x growth is a pretty big marker to kind of take away with. And for those projects that have raised capital, whether it's through an ICO or whether it's through VC funding, there's a significant amount of capital in treasury for these projects. So despite a downturn in prices, you're going to continue to see momentum in actually building applications. So that, even in a downturn, you're going to continue to see more applications coming live. You're going to see a lot more use cases coming to market, and that is really exciting for someone who is building in both building in the ecosystem, and then of course investors who are going to continue to deploy capital in the space. And let's look at kind of evidence of that, right? So the Ethereum GitHub community, GitHub is where developers are submitting lines of code to kind of work with the community, has been extremely robust over the last year, and that's really exciting. So GitHub commits or lines of code being committed to the community at all-time highs for blockchain projects, and that's a really important kind of takeaway here. If you look over to this side, these are the three main kind of consortiums within the blockchain ecosystem. These consortiums have over 750 companies that are building building using blockchain-based systems. So either they have a board-level mandate where capital is being deployed for industries that are going to be impacted in a much shorter term, versus folks that are thinking about longer-term standardization and what that really means from a blockchain-based system that needs to be to support it. And evidence of that. So if you look at what happened in 2017, 2018, blockchain really went mainstream from an institutional perspective. And this is not about just investing. This is actual applications being built, and primarily starting with a lot of the financial institutions that you might be familiar with. So JP Morgan, for example, has come together with a group of banks to basically build an application called Quorum that's a private chain and a blockchain for these banks to be able to kind of interact with, and that's really cool. Goldman Sachs is working on a couple of things, a trading desk along with bringing a stable coin or a digital dollar to market. So right now, Bitcoin and Ether aren't great currencies given the volatility, and Goldman and a few others are working on bringing digital dollars basically, which is really cool. Fidelity, of course, will continue to serve their clients as they do, but they've been one of the first movers from a blockchain perspective, going back to almost 2010 when they said they were actually plugging their servers into to various blockchains to mine. Amazon Web Services is providing a suite of services to blockchains to be able to provide all the support that they do for developers today from their web services applications, along with folks like FedEx who are building supply chain based blockchains. So unbelievable sort of movement forward, especially when you think about these large institutions understanding the disruptive nature of this technology and starting to think about where they start building. And if you take it down to another level, you start to see the on-ramps being laid. So someone like Bloomberg and NASDAQ are already running their sort of experiments. NASDAQ has been quite open with what they're building. They see the infrastructure being an unbelievable sort of differentiator or efficiency sort of play from a capital markets or an exchange perspective. If someone like Bloomberg obviously being able to then plug into that. And you're seeing a new group of folks coming in. Galaxy Digital, which is Mike Novogratz's fund, now has I think over $1 billion of capital committed, and has been investing in the space for some time. Companies like Coinbase, which have now become household names, just recently raised a round at I believe an $8 billion valuation. T0, which aims to be a new exchange, so think about a decentralized or hybrid exchange that competes with NASDAQ, so where you can trade equity products across borders, which will be extremely valuable from an efficient market perspective. And if you take a step back and realize why that's happening, it's because there is a lot of support at the government and the sort of policy level. And if you look at the Bank of England, the ECB, the Monetary Authority of Singapore, these folks who are often central banks are moving towards thinking about what a digital currency really means. In fact, they're doing real-time gross settlement cross-border transactions with each other. So these are central banks across countries that are transacting using blockchain, which is unbelievably powerful from an adoption perspective. And the reason they feel comfortable doing that is because, obviously the regulators across these sovereigns are willing to put out policy and be a bit more forward-thinking. The SEC most recently just announced their fintech sort of hub to create sort of a sandbox environment where folks can come in and run tests. The FCA, which is the SEC equivalent of the UK, they're actually in cohort 5 of accepting folks into their sandbox, so they're a little bit farther ahead. And then, of course, you have folks that are writing policy just straightforward and not even going into that sandbox phase. So, one thing to think about: firms are building. They're building real-world applications. They're thinking about things like custody. They're thinking about things like exchanges, security issuances, and all of that now allows you to build new products, new financial instruments on top of that. And again, that's one of the main things to sort of walk away with if you were to walk away with anything here. There are real applications that are being built at the highest levels, both from government and Fortune 500 companies across the world. And I guess just a recap of what we've seen over the last 10 years or so. You've seen cryptocurrencies come to market. These can be anything like Bitcoin and Ether, stable coins, which are basically digital dollars or digital pounds that allow you to kind of integrate into these blockchains. You're seeing consumer tokens, so kind of like the train token that I mentioned. You can imagine a Microsoft token that allows you to use Microsoft applications. Microsoft actually just recently announced a self-sovereign identity being a core component, going against things like Facebook that have been places where identity is being managed and often compromised. You're also seeing real-world assets be digitized. So, take this building and instead of having paper-based shares, you now have digital shares and a digital representation of that individual asset. That's really cool. And then you have basically securities instruments being built on top of that. So, if you look at from a fintech perspective, a lot of use cases going down into each one of these 4 topics. And it's across industries. It's not just finance. It's in agriculture. It's in healthcare. It's in supply chains. All these industries are being impacted, horizontally and then vertically as well. And that's a lot of noise. That's a lot of noise to go through, especially after just lunch and some drinks, perhaps. But in order to kind of distill what the 5 key themes are and where you really want to start paying attention for 2019, Consensys's view is largely in these 5 areas. So the first is core components for blockchain, where features are kind of complete across the tech stack. And what I mean by that is applications that allow developers to basically build. So core components are things that allow you to basically transact on the blockchain. So maybe Mo has a digital wallet that holds not only my digital currency, but also my digital shares. Supporting infrastructure for scalability. So as volume increases, as all of us are starting to transact on blockchains, there's a lot more that's needed from an infrastructure level. Alternative financial ecosystems are starting to form. So all those companies that we saw earlier, they're looking at their blockchain pair. Web 3.0 applications for consumers. So things like CryptoKitties was just the start, and you're starting to see a lot more shares, a lot more applications not only being built by the Fidelities of the world, but a lot more consumer-facing applications that abstract the blockchain complexity behind the scenes. And then finally, blockchain intelligence. So what I mean by that is, initially we had a bunch of applications being built, but now data has been gathered, and that data is now being integrated into these blockchain systems. So now you start to see much more robust and more efficient building. And within each one of these, you can go kind of pretty deep. So feel free to grab a picture of this too. But basically, there's a spectrum between developer-facing tools that are going to are being built, and then user-facing tools. And then within that, you can kind of go deep within all the details there as well. How am I doing on time? Pick it up. Okay. I'm done. Okay. Very quickly, and that means Ethereum needs to scale. So despite the downward trend in prices, as you can see, volume on the Ethereum blockchain is extremely high. Applications are being built to kind of solve for that scaling issue. So I won't get into the details given we're coming in on time, but there's some of the brightest minds in computer science that are solving for scaling these protocols. So imagine having to take the internet and scale it up. And that means kind of where are we in the development curve? We're here, a long way to go. But that being said, I don't think there's any more of an exciting place to be today from a developer's perspective. Ideally, the investors as well. And although we're here, for me, it definitely feels like when I'm at the top, I'm kind of feeling like I'm upside down. But as you can see by the faces of these people, there's no exciting place to kind of be for me, and hopefully for investors as well. So with that, I'll stop. Cool.